Have you ever wondered how the wealthy keep getting wealthier? The secret isn't concealed in a hidden treasure chest or an ancient scroll. It's all about investing. Investing is the craft of nurturing your money, allowing it to grow and multiply. Think of it as planting a seed and watching it sprout into a flourishing tree. There are four main avenues to explore: businesses, paper assets, real estate, and commodities. But here's the twist. It's not about scattering your seeds in every direction. It's about strategically integrating these investing styles. Consider McDonald's, a household name worldwide. They've masterfully integrated into business by serving up tasty burgers, real estate by owning prime locations, and paper assets by being a publicly traded company. This integration, not diversification, is what shields their wealth and keeps them ready for the next big opportunity. So are you seeking gradual capital gains or focusing on cash flow? It's like deciding whether you want the goose that lays golden eggs or the golden eggs themselves. Having understood the art of investing, let's dive deeper into the four main avenues of investing: businesses, paper assets, real estate, and commodities. First off, investing in businesses. This could mean buying shares of a company, becoming a part of their success or failure, or starting your own business, turning your entrepreneurial dreams into reality. Next, we have paper assets. These include stocks, bonds, and mutual funds. They are called paper assets because traditionally they were documented by paper certificates, although today they're largely digital. Thirdly, real estate. This involves investing in property, either by buying to rent, providing a steady stream of income, or buying to sell at a higher price, aiming for a hefty profit. Lastly, commodities. These are raw materials or primary agricultural products that can be bought and sold, such as gold, oil, or wheat. These are tangible assets, and their prices often rise with inflation. Understanding these avenues, their risks and rewards, will help you make informed investment decisions. Remember, it's all about integrating these avenues strategically, not just diversifying blindly. To make investment decisions, you need to have a clear understanding of the macroeconomics and the microeconomics. This is a bit like having a bird's eye view of the forest while not losing sight of individual trees. The macroeconomics is the forest, the bigger picture of the world economy. The microeconomics, on the other hand, is the tree, the specifics of the investment itself. Let's paint a picture. Imagine investing in a company with a fast-growing niche, say a tech startup. It's promising, right? But what if this is happening amidst a brewing global recession? Timing in investments is vital. You might want to hold off, wait for the storm to pass, and buy at a discount instead of entering at the wrong time and potentially losing your investment. This underscores the importance of integrating macro and micro perspectives in making informed decisions to maximize profits. After all, it's not just about investing, it's about the investor. It's about making an informed decision on where you will invest and secure your life savings. But what about saving? Should we save in cash? It's a common question with an unconventional answer. Historically, people trusted in the gold standard, where each unit of currency was backed by a specific amount of gold. However, those days are long past. Today's money is essentially a form of debt with no tangible asset to back it up. So where does that leave us? We should be saving, but not just in cash. Instead, we should be focusing on assets that we believe have intrinsic value. These assets could be anything from precious metals like gold and silver to digital currencies like Bitcoin, or even commodities like oil. These assets tend to hold their value or even appreciate over time. This means your savings are not just sitting idle, but are actively working for you, growing in value and providing a safety net for your future. Remember, it's not just about saving, it's about where and how you save. Now that we understand the basics of investing and saving, it's time to put this knowledge into action. The first step is a change in attitude. Often, the biggest hurdle isn't the lack of knowledge, but the fear of taking action. It's time to shift from a mindset of saving for the sake of accumulation to investing for wealth generation. Next, chart your course to financial independence. Draft a 10-year plan that outlines your financial goals and the steps needed to achieve them. This isn't a rigid roadmap, but a guide that will evolve as you learn and grow in your investing journey. Remember, investing isn't a sprint, it's a marathon. It requires patience, persistence, and a willingness to learn from both successes and failures. But each step you take brings you closer to your financial goals. Take the first step today and start your journey towards financial independence.